Hi there, everyone. Welcome to this week's earnings season mini webinar podcast series. We're in week two. Obviously, things started to heat up a little bit this week, but obviously we really do kick off next week. Just general advice warning, the content presented in this webinar or podcast is for informational purposes only. It's general advice, does not take into account your personal objectives or financial situation. Please seek professional advice before making any decisions. Rightio, this week or last week's winners, AMP surprised the market this week. They had pretty solid financial results. Mainly, I think, not on top of those financial results, necessarily their outlook, but their structural changes to the business really gave investors a reason to buy in. Obviously, I thought that was a bit of a risk last week. They have actually done exactly what they've said they were going to do, which is sadly a bit of a surprise for this company. So they're up around about 13% yesterday. This morning we had REA Group. They reported exceptional results, and they also had a pretty solid outlook as well. And but another really big winner this week was Life 360. 360 is the code there. They've got a stellar. They've lifted their guidance, and it's an absolute stellar guidance. They're up 20% this morning, so wasn't necessarily on their current results. That's been the definite theme of this week so far. Outlook and guidance is going to be the absolute key. And the best example of that is going to be this next one here, Ordinate, which released guidance, which they didn't need to release on Tuesday morning, which was the morning after we had the big drop in the S&P and the third highest VIX spike in history. Bit of really unfortunate timing from the company. They did report really strong preliminary unaudited results. Their earnings aren't out. Well, their official earnings aren't out till the 19th. So you've got to question their investor relations people really on this one to release on possibly the worst day to release guidance, which they're not, they're not required to necessarily release. Pretty much, it's the worst day one of the worst 3 days in the last 15 years. So a little bit unlucky there, and then there was a really big sell order market on open, which pretty much put a cap on it. It has since rebounded. It opened at 650, bounced straight back to $10 in the morning session on that day. But it was all on outlook, basically. FY25, they're suggesting a transitional year and no growth. So obviously being a growth stock, we're still really confident in this one. It's one of our holdings. They still have a great moat. They're still well ahead of their competitors. They've got to recontract some of their software as a service customers. They've got new product lines coming out. However, that was as I said, a number of or a combination of different reasons why it's back up above $9 now. But all the analysts have brought their their expectations to sort of being capped at around about the 10.50 mark from here on in. What that outlook does, though, is it really leaves. We were looking to add, and then we've just made the decision in the end that they've essentially capped any upside growth in the share price by giving a forward outlook a year out. No growth. So it realistically, we will definitely be adding to this position at some stage. However, at this stage, there's probably no rush given the broader volatility and weakness in the market. Now, QBE, they also reported this morning, really solid result, doubled their profits after tax, increased their dividend. However, outlook and the North American business is still a little bit of a problem child. So they've opened down 4%. We looked at the initial result, which is rear view mirror, and thought, well, QBE will do pretty well this morning. And obviously, reading deeper into it, despite them doing the right things, this is one of these earnings seasons where you are going to be pretty punished for any sort of lack of guidance. And I would say as well, any companies not forecasting future guidance are going to get punished as well. So it's all going to be, we are at a transitional part of the rate cycle at the moment. The RBA didn't raise this week. and that probably means they're inevitably on hold now, and the next move will be a cut next year. But the US is obviously always 6 to 9 months ahead of us. We are looking at a slowdown. Massive fears spiked about US recession this week. They have calmed down. However, this is the sort of earnings season where it's going to be likely more about the next 6 to 12 months rather than how well they go. So the companies that are going to report that are going to do very well this earnings season are going to need both. If they are lacking in one or the other, they are highly likely to be punished, judging by the general market sentiment at this stage. Rightio, bringing to the week ahead, which is what everyone's probably looking for. Much bigger week this week. Obviously, Monday, JB Hi-Fi, REA Group obviously released early today, so that's not there. Tuesday, we've got CSL, Challenger will be interesting, the annuities business. That's one of our holdings we're quite positive on. So a couple of coal names in there. We're quite bullish on the coal sector at the moment, particularly with the yen strengthening heavily, about 12% against the US, against the Aussie dollar. They're our major trading partner. So our alpha recommendation services or our more active clients are buying Stanmore because those coal companies have come off with the recession fears over the course of the week, about anywhere up to 15%, whereas the coal price is actually up. So, and our major trading partner isn't China in the coal sector. It's actually Japan at 30%. China is only around about 22%. So we're not quite as affected. It's one of those broad stroke moves that realistically, it's probably provided a bit of a buying opportunity here. And coal's sitting at around about sort of the 10-month highs. So Wednesday, really big day. Computershare, Commonwealth Bank, Cochlear, Domain is a bit of a growth stock there. A couple of REITs. And essentially, Commonwealth Bank we're going to cover a little bit later. Cochlear is in our summary as well. Computershare we quite like. It's sort of sitting towards the top of our wish list at the moment, or our buy list. However, we would like to see these earnings. Thursday, Telstra. I've highlighted that as important because a lot of people have it. We haven't looked at Telstra for a long time. It's really now that we can get yield in fixed income. Our general advice on Telstra is it's not yielding enough. The benefit of high interest rates is that you get high interest rates. Why not just be in something where you can sleep at night and get a higher yield? So Pro Medicus and Goodman Group are the absolute key releases. This is two companies that have absolutely blitzed their peers in the last year or 6 months to a year. There are concerns around valuations on both of those. That is going to be a big one to watch. Both of them are very very boisterous, very in terms of and bullish their own outlook. I would not expect them. They're not like what Ordinate's just done and been very honest with the market. They tend to be a fair bit of chess betting in those. So don't think they're a huge risk, and they're both quality companies. However, the market is valuing them extraordinarily high. ASX, look, they're extraordinarily low, and I think any result that is not a disaster is a good result for ASX generally, given the last couple of years. They've got to lift their game because regulators in Australia at the moment have protected their monopoly for a long time in the national interest. But they've just about had enough of how lazy and lethargic management have been, and how frivolent they've been with money and their position. So you would expect them to hopefully lift their game after some staff movement. Mars Group's on Friday as well. That's one of our favourite. We've only got two small caps. That's one of our favourite small caps in that industrial space. We expect that to do quite well as well. Obviously, on the economic front, CPI, PPI in the States, realistically now we've got, the US is now just, the analysts and investors have decided that inflation is under control and that it's in the rearview mirror. So these inflation numbers are very much reducing in importance. We're going to start raising the importance of things that are leading indicators, like retail sales, like manufacturing data, and purchasing managers indexes and employment data. So there's going to be a bit of a transition from less of a focus and less of a market reaction from the inflation data, and much higher market reaction, or much more significant market reaction on those leading indicators, because we are, whilst there was a little bit of a panic that has since subsided this week. We, at the peak panic, we had US traders on social media calling for emergency rate cuts, and and really fretting about that recession. Commodities have been hit really hard this week on the back of that. We would expect that to probably start to rebound, which it has today on Friday. So yeah, that's just a bit of a change in sentiment as to what the analysts are now looking for. So outlook is key, not only in the companies, but also in the economic data. There's some US numbers there. Walmart might be watched. Cisco probably not as much, but and then maybe Home Depot for the Home Depot and Walmart for the consumer as a gauge for the US consumer. Be one to watch. And Aussie employment is on Thursday as well. And been super strong numbers there. The RBA will have their fingers and toes crossed for a weaker number. Rightio, preview CSL. Analysts are super bullish on this stock at the moment, but you just can't deny the fact that this stock has had a 310 high and a 240 low for nearly 4 years straight. We've been trading the range here at MPC. We've made very good money out of that, probably 50 to 60%. Just rotating half of our position in CSL, sometimes all of our position. The analysts have a really bad habit of calling this a buy when it's at highs and panicking when it's at lows. We don't have any on at the moment. I would probably be fairly cautious. They had a very disappointing write-off in that phase 3 trial. They did expand capacity for the plasma collection by about 30% over COVID. That may filter through. But look, I can't see this thing breaking to the upside, despite healthcare being a really positive sector at the moment. So I'd probably be a little bit wary there. Nick Scali today reported a drop of 18% in profits and is down 5%. Just on the right-hand side there, I think this earnings season, the little chart there is the Consumer Discretionary Index. It's at record highs. The consumer's been relatively strong for this, for the last sort of 6 months. If you're going to get a positive result here, I would probably, if it was me, I'd be selling into it because the forward guidance or the forward outlook for the economy is a likely slowdown. So if you're sitting at record highs, but you've done really, really well out of these stocks this year, you're probably going to get a pretty nice little divvy out of them. JB Hi-Fi is high quality. I wouldn't be selling any of those necessarily going in, but you probably take your chance to take some off if you've got them on. Goodman's, cautiously optimistic. It's more the valuation. So it's more where the market's got them priced rather than how well the company will go. I would say there is risk to the downside on this one. They've got about 80 projects on the go at the moment, about 13 billion in projects all around the world. Obviously, labour and commodities costs have been quite high in this period. Excuse me. But look, you've really got a risk that that it only takes a few projects to go wrong, and this could disappoint because it has rallied near 50%. The rest of the REIT sector is nowhere near as positive as these guys. So it is a market darling. So just be a little bit careful if you've got those on. Probably buy the dip if they get significantly hit. Cochlear. Analysts, CBA, Fortescue, Cochlear, 3 stocks that analysts regularly are quite bearish on, and they get wrong. They've surprised to the upside in terms of price action on the last few earnings reports. There is an expectation that they won't deliver this time around. There's a bit of bearish sentiment. Look, again, yet to be seen. Viewers pick this week is Pro Medicus. Shout out to one of our clients, Jackie, who has absolutely killed it on this stock. she, she put in this request because obviously being the first week, we were low on requests. It's been a superstar. It's up like nearly 80%. Caution is warranted short term, but you'd be buying the dipper under 100 basically. Trim pre-earnings is probably the recommendation here because there is a lot of even one of the things that rang true with me was Citigroup said they are ultra bullish on this stock, and even they think it's probably $20 overvalued. So I think it's a great long-term hold. As you can see down the bottom there, they've performed pretty well, apart from last earnings, which was a great dip buying opportunity. They performed well on the day overall. Starting to go a little bit over time here, guys, but we're really close to the end. Risk alert, Commonwealth Bank. So it was incredibly hard to even find an analyst that wasn't ultra bearish on this stock. The highest price target for CBA is $107. The lowest is $85. We traded a 137 high at the end of July. This one, there's been a lot said about the yen carry trade. This is a stock that really benefits from the yen carry trade. So don't expect that bullishness to continue from offshore inflows. It's pulled back down to about 127 now. This is a major risk for me. Earnings, dividends, and revenue are not expected to go really anywhere for the next 2 years. Not just the next year, but the following year as well. Their term deposits are now yielding more than their actual stock at these levels. This thing's rallied 20% in the last 12 months, and even the company themselves aren't that bullish. There is a lot of negative sentiment. There's a challenging outlook. I'd be getting out of this thing. I think you'll probably get a chance to get back in around that $100 mark there. We're at a record PE for this stock by quite a margin here, as you can see in the chart there. Look, everyone is so bearish this stock. I don't see it having a cataclysmic fall because I would say it would be quite well shorted, and a lot of retail have actually exited this stock for the first time in a very, very long time, if ever, in the last quarter. So yeah, that's one that you need. I think you'll get cheaper, but there is better yield. There's better yield elsewhere. So, guys, how can we help you? So, obviously, just if you scan on the QR code, obviously we've skipped through this really quickly, even despite being a little bit over time. If you scan that QR code, you can download the PDF and you can read back through. You can see the charts, etc. If you're worried about one of your holdings this earnings season, send your viewer requests in. I ran a Twitter poll, and we've got Lavisa and Wesfarmers coming up over the next couple of weeks based on that vote as well. But we do risk management reports here. We obviously have a balanced portfolio. We have short-term recommendations. We do portfolio reviews, etc. So just get in contact via the website or my emails there. But I look forward to chatting with you next week.